bit of a out there facial expression to open up, but yep.
So Drew's preparing for his time in the United States on a junket. So you need to get your game face on, mate. You don't go over there and walk around looking like that.
Quite a short one, very short one. I won't be layering up for that either.
Is it warm over in California?
It's like 27, 28, 31 degrees.
Wow.
Beautiful on the beach, I think.
Wow.
That's for those listening at home, Owen and I are both layering up today. So
yes,
spring weather in Melbourne.
Ooh, speaking of, my collar's all over the place.
Multiple layers.
New branding coming to the Rask network soon, by the way, Drew.
Excited.
This is going to change.
Sponsored by Country Road, Rod and Gun, someone.
Rod and Gun. Drew's just been entertaining me on what this actually is. I didn't know what it meant. Rod and Gun. That's RODD ampersand and GUNN. Rod and Gun. If you're listening, Drew would like some merchandise. Other than that, we're going to be talking about emerging markets. We got some things to talk about. There was I think it's the 5th biggest corporate deal in Australian history, was the sale of AirTrunk by Macquarie and someone, Canadian pension fund.
Pretty much every single investment bank in the world was involved in that deal.
Yeah.
But that's just a story that I think a lot of people dream of, but it's such low probability, isn't it?
Well, from zeros to 23.5 billion, the former CFO
8 years?
Yeah, so under 10 years, I think it was in total. And they've sold it to Blackstone, which has a portfolio of around about $60 billion. Wait, let's start with what the hell is AirTrunk? AirTrunk is a data center provider, kind of like NextDC, that has a big presence in Asia. That's it. And now people have thought, what's NextDC?
He went around trying to raise money to buy one data center for $15 million back in 2016. I was searching through articles of it, and that's grown into, I'm sure people laughed at him at the time. So what do you need a data center for? And it was like, back then it was like literally document storage. Maybe some people were using Dropbox. And now it's like one of the most important infrastructure assets in the world. And he's just gone from zero to, where was he working before? 24 billion.
Yeah. So 24.
This is a cash buyout too, isn't it?
He personally, I can't remember pronounce his name off the top of my head.
Robin Cooter.
Yeah, that's him. He was the CFO of NextDC, I believe, and he personally is getting 500 million. This is reportedly. I don't know. I actually don't know. I'm not mates with him. I haven't asked him. 500 million in cash, and I think he's got 500 million in some sort of equity thing with the new arrangement. But the big winner from this is definitely Macquarie Group. Macquarie owns a fair slab of that business. But they hold it in Macquarie Asset Management, so they're going to get a stupendous performance fee. The rumor is that I don't know the details specifically again, but it looks like it's going to be in the hundreds of millions of dollars in performance fees.
It's a nice little top up. That's one of the benefits of investing in Macquarie Group, MQG, isn't it?
Yeah.
That when deals are good, and they're in every second deal, they're one of the biggest investment banks globally, you get a nice tailwind of performance fees.
Speaking of performance fees, credit where it's due, the Dome, aka Luke Laradif, came on this show a little while ago.
Now he's swanning around in Como at the moment.
He's doing something like that. So
he's got a performance fee?
He probably does, because for anyone that's watching, I can share my little screen here. He came on and talked about this business called Global Data Center Investment Fund. Him and Ben, that's probably, no offense, Luke's probably Ben's idea. So he come on and talked about this company, Global Data Center Investment Fund, ASX ticker symbol GDC, which I believe had a very small stake in AirTrunk. So I could be wrong, but I remember I was laying in bed last night reading about the AirTrunk deal, and I was like, wait a second, someone talked about that on the podcast. Who was that? And I think it was Ben and Luke. Came on and talked about this company called Global Data Center Investment Fund. I think it was called 360 Capital. The digital infrastructure fund. So 360 was a pretty popular business recently. But the company, according to the Honourable Google Finance, has a market cap of 270 million. I was trying to calculate what's 1%, bit of pub trivia for you, Drew. What's 1% of $23 billion?
230 million.
Exactly. So
I really hope I got that right.
So a lot of zeros, man. I don't know what's going on.
Panther over here.
But Rod and Gun would be proud of that. So if you look at this, effectively, now I could be wrong. I haven't done this research myself, but I was just spitballing. That's double the market cap, effectively. So I don't know the exact.
If they own 2%, yeah.
Yeah. I don't know exactly, like, because I'm sure they've got something else going on here, but that was interesting. Next DC, which
Well,
is
they said Robin Cooter only was pocketing about 3 billion with some colleagues. So his investment was only around 10%.
yeah, because he sold a few years ago. He sold a big chunk to fund some growth. But this business here, Next DC, which is a Bevan Slattery creation, if I'm not mistaken. There's a bunch of these data centers in and around Australia. I think they might even have a couple in Europe. No, in Europe, in Asia, but I'm definitely around Australia. There's a big one. If you go over the Balti Bridge on the way into Melbourne, if you look left towards the city, you'll see a massive Next DC data center. They're all around the country.
And this is one of those assets that everyone, like a CSL, that everyone thought was expensive. At literally every point of that chart, it looked expensive.
I still don't know how it actually make it a big money, to be honest. But
well, it does. It's got no PE. It's got no dividend yield, but it's got a good chart.
It's got a good chart, mate. It's quite a good chart. What's the other big one? There's another big. Oh, your mates at Goodman Group. I'm pretty sure Goodman now are moving into digital infrastructure and stuff like this. Wow,
they work with Amazon on most things, but then maybe they're working on Amazon Web Services too now.
This is this unsexy property business, but it's the biggest one in the country. 60 billion. Yeah. Look at this after the GFC, by the way. I've just done the
long range chart crime. You can start that in 2009 and you look at what a wonderful chart that was.
So Goodman Group, let's pick on them, went from $30 a share or unit, who knows what this thing is, and then it fell to $1.18 in the GFC.
Yep.
But if we started the chart from there, as you say, Drew, that from $1.18 up to $32, plus a bit of a
3,000% return.
Oh, it's a lot. So this is coming on the back of last week's chat about REITs. What do we mean to say is there are different ways to play this theme of digital infrastructure. So yeah, good fun. What are we talking about next, Drew? We've got to talk about emerging markets. Isn't that what you want to talk about?
Yeah, we've done a bit of a deep dive and kind of getting back to the swing of things. Yeah, what kind of been standing out lately is emerging markets.
Yep.
Whether it seems like, and so some people still consider Australia to be an emerging market in many ways, but they've probably been the place you didn't want to be investing in the last 5 or 6 years. But we get plenty of questions, I think, even both by the podcast and just as advisors with clients that have holdings or they're thinking about having holdings, about what are emerging markets, why you'd even look at investing in them, and what are the biggest influences on them. I think there was a question came through this week on that topic as well, didn't there? Wasn't there?
Yeah. We've got a good couple of questions this week. We're going to talk about SMSFs. We've got a question about the IVV ETF and what the Jesus is going on there. And then there's about emerging markets as well. But interesting, Drew, whenever I think of emerging markets, I bring up the Hang Seng Index. And I see that over 5 years, it is down 35% versus, like, say, the S&P 500.
You'd say the Hang Seng, I mean, that's a Hong Kong, isn't it? Yeah.
Yeah, up 86%, neither including dividends. So shocking. a lot of people see that and they're like,
it's had other periods too where emerging markets, economic growth in emerging markets was really incredibly strong, but the markets nowhere near kept up. There's other periods where their share markets have done well, but because of what happened with the US dollar, performance basically went sideways. And naturally, not much has outperformed the US equities in the last, I'd say 5, probably 10 years.
Yeah. There was a period there where, like you said, the US currency was pretty robust and the emerging markets indices started to do really well. It was probably about 5 years ago, if people remember, like the Alibaba fiasco.
Yeah.
The Ant Financial thing where he kind of disappeared. Don't hate me, CCP, just read in the news. So that kind of happened at that moment in time, which was probably about 5 years ago now. Things just went completely different directions. The US powered ahead. A lot of the emerging markets started to take a hit. The Russian issue happened with the invasion of Ukraine, and that meant that Russia was removed from a lot of indices, Drew. There's been issues with Brazil and different political things going on there. So there's been these major emerging market economies that have been a little bit risky, which is probably what we know them for, but they've probably been riskier than usual. While at the same time, everyone seems to say that they're cheap.
And I mean, you say that good diversification means everything's not moving in the same direction at the same time. It's not diversification. It hasn't paid off, and it's probably done as it's not like it's fallen as we saw 50, 60. Like it's not significantly underperforming. It's just not delivering consistent growth that you see from other developed markets. But when the attraction is naturally there, the reason they're emerging is because they're growing at faster rates than the developed world. And if a country, examples of China, Brazil, India, Indonesia, I wouldn't put Russia. I mean, no one includes Russia in there anymore, and for good reason. And they're all continuing to grow significantly faster than the rest of the world. India's at 6.7, Indonesia's 5.1, China's even at 4.7, and Brazil's at 3.3% in annual GDP growth. Which essentially what you're looking for is if the economy is growing faster, the companies operating within that economy should be growing faster, compared to the Australian share market, where earnings growth I think was negative this year. So that's the attraction, but they're also emerging, as we know, because their capital markets, so like their share market, their bond market, their legal rights, which we've talked about in the past, and property rights, like we saw in Russia, where the government essentially just took ownership of assets. So property rights aren't as progressive in some emerging markets, for lack of a better word. And one of the things we talk about, when we build portfolios, we're looking for specialists in certain areas. But one of the things we talk about with emerging markets is if we're sitting here together 20, 30 years from now, in our rod and gun outfits.
Oh yeah. And the grandkids will be wondering
where do you think the growth's going to? Where do you see the growth as having come from in your portfolio? And it's like looking at it now, the population, the consumer story, the evolution of emerging into developed markets. It's clear that a significant portion of that growth is going to come from Asia and emerging markets within Asia. No, I think there's kind of consensus around that, but it's a matter of which parts of Asia and emerging markets actually are able to deliver and perform strongly and convert that into share markets. You're recording this.
Normally when you everything's being recorded, just so you know, it's on record. Normally when you come out with some like big grand statements such as this, we do record this. So I'm going to ask you, Drew, China or India 30 years from now, what's performed better?
China.
Okay, I'll go India. Let's go. Hey Siri.
You don't have to always disagree with me.
Remind me of. It says it doesn't. Anyway, I'm going to ask Siri to remind me of this. In 30 years, who did better? Do you reckon Siri will still be around in 30 years?
No chance. It'll be the Chinese version of Siri.
We Siri. Anyway, we can joke, but I do and don't agree with you, Drew. Because well, first of all, I think India, just slightly more stable democracy, which means more capital flows to entrepreneurs than in the quasi-draconian commie regime. But honestly, I actually think that don't underestimate the ability of technology to solve a lot of the world's problems. It doesn't solve everything, but I think what we could see over the next 5 to 10 years is this big dramatic shift as AI, as autonomous type things become more of a reality for people and businesses and societies. And I actually think that may result in more value accruing to quote unquote civilized or developed nations where the intellectual property rights are more strictly held. So what I mean by that is, imagine in the future, a lot of the work that might be outsourced to China might actually find a lower cost unitary input and output in the United States, simply because instead of the gigafactory having to just, the gigafactory is a good example from Tesla, where most of the cars that Tesla makes are not touched by a human. And those
but in China.
Well, it might be in China. Yeah. But the reality is the value is accruing to Tesla in that instance. and to the US people as a result of their stock market. Of course, you could say, well, probably China's just taken all the intellectual property and so on and so forth. But the reality is a lot of the value is accruing there. So that's why I tend to think that the developed markets will be more robust, because I think even though economic indicators are a good yardstick for what's happening in an economy, I actually think technological innovation is not adequately captured in those economic indicators, if that makes sense. Does that make sense?
And I think it's also important to, China's one of the biggest, or it is the biggest part of emerging markets, but the emerging markets outside of China are incredibly different to China as well. Like you look at, there's still commodity-driven economies. There's more service-driven economies like India, where you can see India overtaking the US in certain areas, versus China that's kind of going head-to-head against the US. So I think, and that's the way we've always viewed it. Like, if you could find they're very hard to find, but emerging market strategy that doesn't include China, or the ability, I think from an institutional perspective, a lot of groups are now separating their China and EM allocations. So it's control your exposure to China because it's the third biggest economy in the world. So that almost demands its own allocation versus broader emerging markets where growth is very different and sectors are very different.
That's a good point. Well,
you're just saying buy FANG again. Is that your solution to everything?
FANG solves this. That and Bitcoin. You only want FANG and Bitcoin. Some professional footballer would call it a barbell portfolio. Anyway, so in other news, I actually think that depending on which, say if you wanted an index strategy, let's talk about active v passive. If you want an index strategy, depending on which index fund you go with, Drew, that index might consider South Korea the home of the mighty Samsung, for people that are out there. Some
as an emerging market,
some index funds might consider South Korea emerging market, when it probably couldn't be further from the reality of what South Korea actually is. So there's really important distinctions, which is to your point about China v everything else.
But this is where one of the areas where we tilt towards active. So the passive products are okay. They track the MSCI, but even I think Samsung's an example, but then TSMC is
one of the world's biggest companies.
Yeah, over 8% of the index. So you're not necessarily getting the exposure that you want. And our thought is if you're going into emerging markets, in a similar way, if you're going into the US and you're an Australian investor, you don't just want to double down on technology and consumer-facing businesses like, Alibaba and Tencent and the same things that you bought in the S&P 500. You want the other sectors. You want the sectors that are benefiting from the huge population, the middle class over there, and the changing way of life, whether it's, urbanization or... so you want sectors like financials, you want healthcare, you want industrials, the same way you want to diversify anywhere you go outside of Australia.
Yeah. Basically, what you're saying is TSMC is the BHP of Asia.
Or the CBA.
Or the CBA. You get a lot of it.
It's the elephant in the room, exactly. So this is the perfect area to do a core satellite, or even do passive core, or just 100% active.
Well, the passive funds in emerging markets in Asia
they're very limited in Australia.
Yeah, and they're very limited, but they're also, you pay 0.7% or 70 basis points in finance lingo. You can pay exactly the same amount. So we recently switched from FMEX, which is an active strategy, into the EMKT multi-factor fund by Van Eck. And that's basically, I think you pay 0.69%. So you're paying 70 basis points.
An active management fee for a
passive
exposure.
Yeah, it's basically rules-based. It tries to replicate a quality index, but in a multi-factor strategy. But whoa, am I talking some gibberish?
It's similar to small caps too, though. So why else would you invest into emerging markets? Because it's less researched. There's 100 analysts look at Apple's report and they can tell you to the 10 cents that's a good accidental segue. You can tell to 10 cents what the earnings are going to be next quarter. But for a $30 billion company in China or Korea, there's 5 analysts covering it. So the ability to find something within those companies compared to in developed markets and find an edge and find that alpha or outperformance should be significantly easier. It is the problem more recently is that the tide being the market hasn't been rising. So just staying above water has been hard for most active managers.
Yeah. Interestingly, I was thinking about Starbucks. Don't ask me why I hate the coffee. But
we're not going to get
there was a news article recently.
Product from them, are we?
Don't send us your coffee, Starbucks. Do not. If you're thinking of like trying to manipulate us here on the Australian Investors Podcast, do not even attempt it. It will backfire. Maybe that's what they're going for. I don't know. But anyway, interestingly, Starbucks have imported a new CEO from Chipotle. And Starbucks is an American listed company that has a huge presence in China.
Yeah.
And that's an interesting example of a company where you probably don't need to buy the Chinese equivalent if you're looking for a Chinese exposure, and you can let the minds that be at Starbucks manage that currency, manage that business and geopolitical risk for you in a way. Similar to businesses like Nike, mentioned Tesla already. A lot of businesses like Apple do a significant amount of their revenue from China, while also benefiting from the economy, lower cost of wages, industrialization, et cetera, et cetera, et cetera. Is that a view that you think about, Drew?
I think you consider it, but when we're looking at diversifying China, we really want, or China or emerging markets, we want on the ground exposure to the trends and the themes that are happening in that country, not just the high level ones. It's like similar saying, you're buying CSL, so you've got global exposure. I mean, most of the earnings are overseas, but it's still
Australia, mate.
Yeah, exactly.
It's like, I was in Rome the other week for our Europe trip, and I just needed to get outside the city because I needed something that was actually Italian to eat. And sometimes you just want the
pure... Go to the service station.
One
of the best paninis outside of Milan at the service station.
Went to Greg's in London. I tell you what, that's authentic English food.
We digress.
Sausage and cheese.
I mean, the currency is the big one, and that's probably been the biggest issue for emerging markets.
Yeah.
No, because a lot of emerging markets don't have that many, that much of a evolved capital market. That a lot of the debt they raise has to be in US dollars, which means as the US dollar is more valuable, their interest rate, it becomes incredibly expensive, and the economy is capped. But also, if this US dollar is doing well and the interest rates are high in the US, people naturally gravitate to the US, particularly at times of volatility and stress. So if you think rates are going to be cut, and a lot of people are now predicting the US dollar to weaken, that should be a tailwind in the short term anyway for emerging markets or anything that's leveraged to the US dollar.
Is that a guarantee?
Should.
Okay. Make sure. Pretty strong language from you. Okay, so we know that you can take active or passive because in these types of markets, ETFs aren't always perfect. Like the reason that we switched into EMKT is because it applies a quality filter like an active fund would, like tries to avoid, corporate governance issues and excessive debt and all that sort of stuff. But it does it in a rules-based way. And so that, in our opinion, seems to be a sensible way to go about things in these markets. But Drew, the other question that people have is they're like, okay, well, I'm picking up what Drew's putting down. This is like the engine room for economic growth over the next, say, 20 or 30 years. And the guys have explained that maybe, you could take active or passive or probably both, to be honest. But then what type of allocations do you typically look at when you've got a client at Waddle Partners? Like obviously you deal with retirees, but like a typical balanced portfolio, what type of presence does that have in these types of markets?
Yeah, I'd say so. If you have an international share allocation, our starting point would probably be 50 passive, 50 active, 50%, 50%.
So it's in half of that sliver.
Yeah, so half of that. Yeah. And then within that, I'd probably say that'd be split into anywhere from 4 to 8 managers, but on average, probably 5. Right. So you're thinking 12.5% of as a starting point, and then it depends on. It can also, there you go. First, it depends. It can depend on what your objectives are and the valuation of the other indices at the time as well. So sometimes you could have 2, if you think about it, 2 active managers within that group as well. So double that.
So just to confirm, you're saying how much is in the in the emerging market?
As much as a quarter of your international equities allocation, I'd say.
A quarter of your international equities, and then 1/2 of that is active, 1/2 of that's passive.
That'd be of just in our portfolio, it's all active.
Oh, okay. Yep. All active. Yep. Okay. Gotcha.
But you could think about it that way, that it's 25% of active, including a half once you're in there as well. That's probably your starting point. But I think the lack of index options means it's more likely to be active or more targeted.
And then just one final question before we move into some really quick news bites and questions is, do you think about, we've got a question about this actually, which we can probably bring in now, because I'm going to ask you this for emerging markets, but you can also apply it in any other way. Here we go. This is from, and I might insert a disclaimer here. Anything that you do here on the show is limited to general financial information only. We don't know your needs, goals, or objectives. So none of the information that you hear on a Rask podcast is tailored to you, your needs, goals, objectives. Always seek the advice of a licensed and trusted financial professional who can give you one-on-one advice. And if we mention anything like funds or ETFs, please remember that they have a product disclosure statement and a target market determination. Read that before investing. Again, speak to a financial planner, like say Drew here. In every Rask podcast, there is a link to get financial planning advice. Go and click that. Now, from Mr. It Depensable, this is the question and name. Mr. It Depensable says, what are some considerations for deciding if/how much currency hedging to incorporate in a portfolio? Is it even necessary, particularly for those with a small investment balance whose major assets will be their home and income in AUD? Now, I'm going to cut the answer off there for a second, and I'm going to ask you that question, Drew, across your portfolios at Waddle, but also when you think about emerging markets, do you hedge that? Do you not? Talk to us about this.
Yeah, I mean, it's big. It's the $1 million question, isn't it?
Maybe 10 million. I don't know.
I think there's a big difference here. So when you're talking about smaller balances, I think the idea that you can continue contributing and that you're going to be investing in that and in that asset class at different stages of the cycle. So at some points the US dollar will be high, some points will be lower. Hedging isn't as important when you're in that accumulation phase. And as we talk about in retirement, you've got a finite pool of capital. So how do you manage the glaring risks that pop up from time to time? Sometimes they don't feel as glaring, but we've talked about, and I know Jamie's talked about as well on the podcast, which is having a framework and rule and a rules-based framework to make decisions on complicated things like currency.
Yeah.
So our starting point is to basically be unhedged and to only consider any sort of hedging once the Australian dollar, most importantly against the US dollar, you can talk about every other currency, but they're the two that really matter for an Australian investor, is outside 3 standard deviations from the mean.
Mm-hmm.
That sounds like more gobbledygook.
No. Sure. That makes a lot of sense to all the technical analysis.
Yeah, exactly. Hopefully it makes, you can probably do some sort of chart about this. And the only time we ever look at a chart, I mean, there's times where you'll see the Australian dollar was over, it was sitting at $1.10, $1.15, $1.20, and everyone always thinks it's going to continue to strengthen. But it becomes clear at some point, the history of Australia and the history of markets is there is a reversion to the mean. So it becomes more obvious that now is a time to be unhedged because the currency is going to fall.
Yeah.
And similarly, when the Australian dollar is historically weak, so I think the mean is around 73, 74 cents, and it does change over time. When it's significantly below that, that's the time that you want to start to think about hedging. Because what we don't want is to see our retired clients lose money because the currency has shifted and remove the impact of what investing in capital markets have done.
So that obviously is particularly important for when you're getting a lower risk, lower volatility asset that produces income. So say like government bonds, you would always go hedged because the actual return that you might get is bugger all anyway. So why would you let it get wiped out by a currency fluctuation?
Exactly.
How about for something like an active fund that operates in emerging markets? Obviously, that's going to be quite volatile. Does it again just come back to where that kind of that framework is around the currency?
And the vast majority of active funds don't have hedged. Maybe I'm talking out of turn, but a lot of them just have active hedging and they take a hedging position, knowing that it's Australian investors that are predominantly invested in there. So we're comfortable with an actively hedged strategy as long as they're clear about what they're doing.
So the fund manager themselves hedge the portfolio, not you selecting whether it's active or passive.
Yeah, and it probably is more relevant when you've got an actively managed portfolio that's a lot different to the benchmark. That's when that active hedging tends to make sense. Okay. In terms of, I think one of the benefits of investing into emerging markets is the currency. So I think that's more one where you'd leave it unhedged unless something glaring is, unless it's fixed income, unless something glaring is occurring.
Yeah, cool. They go on to say, Mr. Dependable, obviously Rask Invest and other services need to pick something that suits the majority of customers, but are there other criteria DIY investors can think of to determine the right allocation for them? My answer to this is very similar to what Drew just said, Mr. Dependable, in that we have a very slight hedged position in the IHVV ETF, so just for US equities or US shares. And there are quite a few reasons for this, but the reality is what Drew just said. If you go 2 standard deviations for the currency, we're actually at that point right now, and we're very close to that. So if I bring up, I'll bring it up on the screen. So people that are watching on YouTube, and I'll talk everyone else through it. If we bring it up, and this is the chart Drew was referring to, it's just here. So you can see that the currency recently, if we take a real close look at this, this chart here in front of you and for everyone watching plots 2 standard deviations, so one above, one below. And it shows earlier this year that our currency at about, what was it at the time, about 67 cents was, or just below, was really close to that mark of 2 standard deviations. So a little bit of hedging made sense. But another thing that's really important to understand is how you manage your behavioral, reaction to portfolios changing in value. So for example, some people, if they only had a US dollar portfolio and they saw the currency swing up and down, like say in the 2000s era, where the US stock market went up, but Australian investors didn't really participate, typically you're going to behave quite negatively and you might have some sort of adverse reaction. You might sell out at the wrong time just because you think you made the wrong call. So for us, by having a tiny bit of hedging, Drew, we kind of ease and smooth that process for people. And if we ever wanted to dial it up, we just add a bit more. If we ever wanted to dial it down, we could dial it down without starting a completely new position. That's how I kind of think about it. And, some advisors will just go 50-50 and just go straight down the middle.
I mean, a lot of advisors are just arbitrary, and just say it's 50% hedged.
Yeah. And I think individual investors, if you're looking for a lot of literature on this, basically, when I go in search of this type of literature for currency hedging frameworks, almost all of the good literature comes from the perspective of a pension fund. So I've said this before, but most pension funds like Australian Super, a big retail super fund, for example, they have liabilities to meet in the future, similar to Drew's financial planning clients. That's a different thing as if you're building wealth, because if you're running a pension fund or you're Drew from Waddle Partners, your client has a need of that money. So you have to smooth that journey, and you have a defined obligation that's going to come sometime in the near future. Whereas for accumulators, which is a kind of different ball game, it's kind of let it run. And over the long term, hedged or unhedged, typically evens out in the wash. Now, Drew, before we get into the remaining questions, we do have a little bit of time here. What was the number one piece of news this week that took your attention?
Putting me under the spotlight here. I mean, the big one was just literally came out just before, which was that economic growth in Australia was continuing to slow. So it fell from a 1.3% annual rate to 1%. I mean, it's exactly what we expected. You can't increase interest rates and expect nothing to happen. And then the only thing really driving it was public sector spending. So government spending was the key contributor to that. Outside of that, probably linked to our A-REITs session last week. So Morgan Stanley must have been listening. The headline read something like, worst could be over for commercial property. They were saying that cap rates, as we explained, had finally settled around historical averages, and there may be some sort of turnaround coming in light of falling interest rates. So,
you know what? I was actually going to bring some gold stars into the office and give you a couple gold stars for that, because I actually thought that was a really good explanation of cap rates. You probably had the best explanation of a complex financial term that I've heard of. And I just want to...
That's twice this week. And the Get Rich Slow podcast as well. You enjoyed that one too.
Oh, yeah. So for those who haven't listened to Drew on the Get Rich Slow Club podcast, easily his best performance on a podcast. I'm still wondering...
It must be the setup. Must be the lounge chair setup. I don't know.
You also had a suit.
I was wearing a suit. That's very rare.
But it was good fun, mate. It was good fun and good podcast too. So shout out to those guys or gals, I should say, over at the Get Rich Slow Club podcast. There was one piece of news that you brought into the mix for this week, which was the top 10 best performers of the
And,
ASX 50.
oh, you're just gloating again, aren't you?
And the bottom 10, as a result of their most recent like financial updates, so it was reporting season, how did those companies do after they released their results? And we did talk about this a little while ago, is WiseTech jumped 29% after releasing its result, which is
Stunning.
unbelievable.
For a company that was already expensive.
Yeah, and Mr. Richard White's, I think, $2 billion happier as a result of that. But Brambles came in second. You held Brambles for a while there, didn't you, Drew?
Not at the moment, but we did. ResMed was fourth, up 9.7, so we've held ResMed.
Yep. James Hardy, don't know about that one.
Yeah, skip that one.
But
then,
the banks.
3 of the major banks were up around 5% after reporting, despite every analyst covering them and pretty much being spot on with their reporting result.
SEEK's result was bad fundamentally, but I think it was better than people thought, so it went up.
Less worse, less bad.
Less bad. And then on the way down, the companies that did pretty gross were MinRes, Mineral Resources, down 12% after results. Cochlear, that's a shame, down 11%. I've just got a soft spot for Cochlear. Even if it goes down, I'm just like, oh. Treasury
Good way to invest your old lawyer.
Just how does it make you feel? Well, it's got a good story. Oh. Santos down 7%. Treasury Wines, fewer people on the Merlots, Drew, down 5.8%. Wesfarmers down 5%. So there's a few companies that got punished as a result of their results.
I mean, like MinRes is just evidence of how hard it is to work in commodities.
Yeah.
Like they're great business, but they're investing heaps of money at a time when lithium prices fallen off a cliff.
Yeah.
And things are so slow moving. So it feels a lot like, I probably shouldn't say that. Remember when Fortescue had this incredible business ready to go in it? Like, not saying it's MinRes or anything like that. It's already much bigger than Fortescue was back then. But investing in the good part of the cycle for the cycle to turn, and then eventually came out the other end.
Yeah. Okay, of these companies that are in the bottom 10 of this list, so we've got ASX, APA Group, which does pipes, Goodman Group, which we've already mentioned, Origin Energy, Wesfarmers, Treasury Wine Estates, Santos, Ramsay, Cochlear, MinRes. If you had to buy one of them with a 1-year view, so you're basically a day trader, let's call it, which one would you buy?
AS6? No, MinRes. I'll take MinRes.
MinRes. So you're going down to
I'm a fully knife guy, so ASX is like, I couldn't fall any further. But then I'm like, well, MinRes, all it needs is a bit of a turnaround in commodity prices, and it'll be leveraged.
So what you're saying is this is a less likely outcome, but if it does pay off, it's going to go big.
Yeah.
Okay, and you've only got a year to prove it. So MinRes. Okay, I'd probably just go with Cochlear.
Surprise.
But Cochlear is an absolutely unbelievable business. And I think the future of a lot of these hardware businesses like Cochlear, ResMed, Apple, a lot of these hardware businesses, I think AI is actually going to be a huge enabler for these businesses. And I think a lot of the businesses that have the trust at the consumer level or business level will continue to win under AI. I think that you can replicate the software, but getting the hardware, the trusted hardware into people's hands or heads, in the case of Cochlear, may actually be a super competitive advantage. Now, Drew, we did promise some questions, so let's get into them. There was one that came through from Clueless, who said, what's a good minimum dollar value for someone just starting out to invest? Anything.
Yeah. Just find a platform that isn't overly expensive to start.
Yeah.
But just getting started is all you need to do.
Yeah, wonderful. Good one. Just start. The good thing about starting small is that the mistakes and the lessons learned are quick and easy. Whereas if you go in with a lot of money, like some people don't start investing until they're 50 and they've sold out of their investment property or their business and they approach it for the first time, I think that's pretty scary and you need expert advice. But for younger people or people that are just starting out with $10, $50, 5,000, just go for it and see what happens. It's a great way to learn. Obviously, keep listening to the podcast. If you're just starting out, the Australian Finance podcast would be a better one than this one, the Australian Investors podcast, because that one is definitely more targeted to beginner, intermediate. The Australian Finance podcast. 63 Art Wynan. I don't actually know what this questioner name is. Was that just a bunch of gibberish? Anyway.
63 Ardinan.
We're going to figure this out before the end of the show, and we're going to realize that we look like the idiots here.
Yep.
Okay, we'll figure this out. But the person who sent this question in said, this is a very good topic, Drew, for you. Can we have more information regarding SMSF? So I would like to know about trusts and company setups. Maybe we can do a deep dive next week, Drew.
That's a good idea.
Or if you have podcasts, let me know and I can find these. Love listening and have completed a couple of the courses. Always learning. Thanks. No worries. That's wonderful. We will do a deep dive for you, but also I did just do a podcast on this on the Australian Property Podcast. It talks about property, super, shares and the different makeup of them. It doesn't so much go into like the company structures and different types of things, but it will be very interesting. So I'll put a link in the show notes to the Property Pod for you on that one. Drew, just as a question for people that are listening, what is the typical minimum that you would suspect someone needs to establish a self-managed super fund?
Yeah, the first thing I'd say on SMSFs is it's an area where you want to get some advice. There's lots of easy ways to set them up, but they usually got some strings attached, so always be careful of that. With the cost of, on average for a full SMSF being about $3,500 a year, we see at a minimum of about $500,000 combined, but continuing to contribute. Mainly because the benefits of the other options like platforms are significantly better than they were. So minimum 500, but most people, it makes a lot of financial sense once you get to something like $1 million in combined superannuation assets.
Okay, so because you can have more than one member, for people that are listening, you can have more than one member be part of the same SMSF. That's hence that you get the cost synergies. And okay, so that's great. Good tips there. B writes in and says, as per the podcast, I started investing in IVV. Do not take your podcast as an investment advice. Let's just cut it off there. No, but so the price shows around $55 per share. But when I listen, again, it says $561 per share. Then I went back and it shows $55, an Australian flag, and $561 and a US flag. I think this person is actually using the Perla platform. And what you'll find, and this is actually an interesting thing. So first thing is the Australian listed S&P 500 ETF, IVV, did a share split not too long ago. So some of the historical data might actually show that it had a share price of nearly $600 for one individual unit. That was broken down, and now you can pick it up for around about $55, Drew. However, it's important to note that all this ETF does, the IVV ETF does, is take your money and put it in the US version.
Yep.
And that one can be quite different. So that's where the confusion can come in. As people know, I personally am a big fan of sticking with ASX listed or Australian ETFs, and keep in mind that they should be Australian from a tax domicile perspective as well. If you don't know what I'm talking about, just Google Rask tax domicile and it'll come up. Drew, the last really good question comes in from Forever Active, which says, or who says, hi lads, you talk about getting access to active fund managers and for portfolios aimed at small caps or even emerging markets. We should talk about that. What active fund managers can us, quote unquote, retail investors, that's what they're saying, gain access to Aussie small to mid cap shares, having a hard time finding one that isn't a lick? Cheers, guys. So they're looking for active fund managers, Drew. We do not make necessarily a recommendation to these types of questions. But if people wanted to study what a good small or medium-sized fund management fund would look like, where could they start?
I think Morningstar is always a good start. I know they don't probably have as good managed fund research for retail investors. They do for advisors. Livewire, this is not necessarily using the content that's there, but looking at who's contributing and the people on that platform, because it's a lot of fund managers. I mean, we've got I can probably reel off a couple of names that are on a short list and on our bench. So we have a portfolio and a bench where we don't necessarily have the space for multiple. Groups like Munro, so Chow Ma, we've heard, have a global small caps. Ausbil does both. Fairlight, I'm not sure.
When you say does both, it does Aussie and global small caps?
Aussie and global smalls, yep, and micros and mids. Yarra, I think you interviewed Dion Hershen recently, so they've got domestic and global smalls. A lot of these groups do both. Lazard, Fairlight, Ausbil, and there's probably another 5 or 10 in there as well. Our bench is, I think, we've got 2 in the portfolio, Australian Ethical for local, 2 in the portfolio and about 8 on the bench.
Fairlight is a great fund manager. It's great fund manager. Global small caps. Ausbil too have appeared on the show. Munro, Nick Griffin has appeared on the show. Yarra, Lazard. We haven't had Lazard on the show, but those are some good names. There's some really good fund managers out there that are more bespoke. It's not really for retail investors, as in quote unquote small amounts of money. Some people will be familiar with Matt Joss from Maven Funds. I think it's $250,000 minimum investment though. There are other fund managers like DMX Asset Management, DMX like the rapper. I don't think that's where it comes from, but that's really interesting. There are other fund managers out there. We've got Wayne Jones from Gaines Capital. These are some great names. They get you on the kind of in the awareness. Twitter is actually a great place to communicate with these fund managers, and oftentimes they'll answer your questions. They're happy to have a chat, those types of things. So some good names there, Drew. Drew, you have to send us off into the sunset with a bit of a dad joke, especially before you go on your junket. Like if this is the last one, if for whatever reason you don't return, we need to get.
We've got another one next week. We're all good.
Dad joke. Oh, okay. So then you'll be joining us from the junket. Okay, gotcha.
Yeah, that'd be fun actually. Let's do that.
Yeah, do it.
Yeah, I can do live.
I've got
with Ritholtz Wealth Management.
Do it. Bring him in. So I like the play on words for this week's question and name. Best question and name every week gets a value investor program valued at $499 on our Rask education platform. Mr. It Depensable is the one that wins this week's award. So if you are Mr. Independable, write into us, send us a message on the Intercom platform, which is the little widget that you see on the Rask websites, and we will hook you up with a free course. Keep your questions coming. There's a link in your show notes for financial planning, but also to ask a question. Now, Drew won't stop laughing, and I do not know why, but I think he's just queued up something that he needs to get out. So if you want financial planning advice, head to the link in your show notes that says financial planning. Don't forget, the Australian Retirement Podcast is starting this week. It features the guy that can't stop laughing over here. The Australian Retirement Podcast is launching this week. You will find a link in the YouTube video or in your podcast player. You can hear from two financial advisors each and every week talk about retirement. What a fun time that will be. So no, but seriously,
it's a bit of healthy competition between podcasts,
yeah. Good luck to you guys over there, I say. No, but seriously, check it out. It's in your podcast player again.
I will bring the dad jokes to the episodes after the first 6.
Plenty of dad jokes in there. Drew, what's your joke for this week?
I feel like I might have said this one before, but I couldn't. As soon as I read it, I've been laughing for the last 10 minutes.
Okay, go.
Right. Why couldn't the produce manager make it to work?
I don't know.
He could drive, but he didn't avocado.
That's bad.
Oh, come on.
Avocado.
Come on.
Okay, I got you, son. Well, Drew, that's pretty good. I'll give you a 6 out of 10. That was pretty good, mate. Thanks for this. Road and Gun, if you're listening, Drew needs an outfit. Mate, absolute pleasure.
Good to see you.